Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Sonia Shenoy, and it's turning out to be another largely sluggish day. Though things have picked up, right? We had a flat start, and since then, markets have seen some buying coming through. Benchmark indices are up close to about 0.25% as we speak, and cement as a pocket is showing you a lot of traction on the way up. So India Cements is up close to about 2%. Ultratech Cement is higher. Grasim, Dalmia Bharat, Ambuja Cement, Rain Industries, Sagar Cement. That's a pocket where across the board you are seeing gains of close to about 1 to 2%. The other big theme in the market has been the kind of block deals that we are seeing in the recently listed companies. You know, there was Nykaa, of course, where Lighthouse has been selling. They sold earlier in November when the lock-in expired, and they've sold again today in the block deal today. Paytm had SoftBank selling earlier this week in PB Fintech, where the lock-in lifted on 10th of November. Tiger Global sold off. So that's been the big trend. So I just want to quickly highlight that there are a few more lock-ins which will expire from today till the end of the week, and that's the list up for your screen. Smaller ones, they're not those, marquee new age tech companies which are very hefty subscription and much larger in size. These are smaller companies, but nonetheless, the lock-in will be expiring this week. Sirma SGS is today. Tomorrow, you've got Venus as well as Starsons. And then on Friday, you've got Ethos as well as Go Fashion, which will be lifting. Now, amongst these, the stocks where you've seen the maximum gain has been Venus Pipes, where the stock price is more than doubled compared to its issue price. And the other one is Go Fashion, where the investors are sitting on a healthy 70% gain over its issue price. So watch out for a couple of these, listings, recent listings, where the lock-in will be expiring this week. Hi.
Hi, good morning. So, even in terms of individual stocks, right? I mean, Paytm is really the one that's getting hit the hardest this morning. And I was just looking at the stock price. It's now not just at a fresh 52-week low, it's down almost 10%. The stock is now down almost 80% from its issue price, which was 2150 rupees. So that's the kind of sell-off, massive sell-off that we've seen in many of these platform companies. Just wanted to keep that on the radar as well. But let's do one thing. Hindustan Aeronautics is what we're looking at. The company delivered a very strong set of numbers. The order book position was also maintained at nearly 8,400 crores. And more importantly, the company is very optimistic of, not just they've raised their margin guidance to 26 to 27%, but they're optimistic that from a single-digit growth that they will see in this year, they're looking to see a double-digit top-line growth FY24 onwards. In fact, Vahishta is here to give us all the details. Vahishta, over to you.
Hi, Sonia. Thanks for that. You're absolutely right. Hindustan Aeronautics stock has been a big outlier this year, up nearly 120% on a year-to-date basis, clearly flying through the roof, just like its products. Everything seems to be working in favor for the company. For the first half of the ongoing financial year, the revenues rose 22%, while margins jumped to 28% versus 21% in the same period of last year. We hosted the management on our channel today morning, and they are quite optimistic on the future prospects of the company. The EBITDA margin guidance for FY23 has been revised to 26-27% versus 24-25%, which was guided earlier. Revenue growth will be single digits in FY23-24, but FY25 onwards, aspiring to grow upwards of 15% on a year-on-year basis. Also, FY25 onwards, the repair, overhaul, and manufacturing business contribution will be equal, so that will be 50-50% each.
The ratio is expected to be for the FY25. The ratio is expected to be in the range of 50-50% between ROH and manufacturing, but for the current FY23 and FY23 and 24, it will be in the ratio of repair and overall will have a higher ratio of around 60%, and manufacturing will be a lower ratio of 40%. And this will be for the next 2 years. And as far as the EBITDA margins are concerned, we have indicated 24-25% in our initial guidance. Our EBITDA margin also is likely to be a percentage point more than what we have anticipated. So it should be in the range of around 26% is what we expect. So it should improve definitely from what we have earlier guided at 24-25%. For the current year as well as for the next year, that is FY24, it is expected to be at single digit as what I have indicated earlier. It will be in the range of around 8%, and the double digit growth is expected to start from FY25 onwards. We are not aware of any such development. Probably the government of India will be in a better position to tell them.
Okay, well, that's HAL. It's been one of the strongest stocks in the last year or so. and now the management is very confident of expanding their margins further. Let's invite our first corporate on the show. BLS International reported a very good set of Q2 numbers with a revenue growth of almost 88% on a year-on-year basis and an increase in profits by 85%. The acquisition of Zero Mass Private Limited also boosted the company's top-line growth in Q2. Note that China is a key market for the company. So Shikhar Agarwal, who's the joint managing director at the company, joins us now to discuss the earnings. Shikhar, thanks a lot for joining in on the show. Just wanted to start by asking you about some of these marquee deals that you've signed up recently, like processing German visas in North America and Mexico. How will this boost your growth? I mean, you're already sitting on a revenue growth of 70% in the first half of the year. What do you think you can do in the second half?
Definitely. As you know, BLS International now is in 64 countries. We're working with more than 46 client governments, and it takes a lot of time to get these contracts with the governments. In the last few years, we have won contracts with the Thai embassy in Kenya, within India. We have won contracts with the German government. So the contract with the German government is the first time outsourcing, where we have to open 10 offices in USA and 2 in Mexico. So since it is the first time outsourcing, we don't really know how many numbers we will get, but it is really gives us a big foothold in the European market. Germany being at the epicenter of the visa outsourcing market, definitely it's the first time outsourcing for us. So we will want to prove ourselves right. And as we grow, I think our numbers and volumes and revenue will increase. And also point to be noted is that we've got it at a higher service charges. More than 30 euro per application is what we will get from our German visas.
This 30 euro per application, what would it normally compare with? And what will be the direct impact on your margins? We understand this should be margin accretive, right?
Correct. So as you know, currently, for our Spanish government, we are working at 15.45 euros. So it is almost at a double price that we have won this contract because of our increase in our technical capabilities. Definitely, it will be margin accretive. We do have existing presence for the Spanish government in USA. So we will be utilizing some of those offices, combining some of those offices. So definitely, as economies of scale come in, it leads to an increase in revenue and margin for the company.
Okay. You've also said earlier that e-governance businesses along with BC together are sizable enough to be pursued with a deeper focus. Any more acquisitions beyond what you've done recently with ZMPL? And if yes, what would be the amount that you're earmarked for acquisitions?
So as you know, now our kitty from the digital business service segment, as we call it, which includes the banking correspondent and the e-governance business, is almost 15% of the revenue of the company post acquisition of Zero Mass, which gives us a revenue of 180 to 200 crore every year, plus an EBITDA of 20 to 25 crores. So that is, that was the reason that we thought that it is good now to focus on this segment as a separate segment. So we are looking at acquisition in both visa outsourcing and e-governance space, because the revenue model of the company is essentially the same. It is upfront collection of fees from the citizens with no dependence on the government for money.
Okay, so you're looking at acquisitions in both the business lines, visa and consulate services, as well as your e-governance business, which you now call digital services. Just about this, e-governance business, what are the kind of margins that you have, the margins that you enjoy in your digital business, which is business correspondence and the e-governance?
Correct. So see, the revenue potential from these businesses is quite huge because the volumes are much more than the visa business in this business. The revenue per application is definitely less compared to our contracts where we collect money in dollars and euros. But the margins from the contracts are quite similar, 14 to 15% EBITDA margin, which we plan to increase year on year, because the same people who are coming into our centers now, we are targeting to sell them different kind of services. We have had some success, be it insurance or travel tickets, so these kind of services will definitely lead to an increase in margin. And, as you know, other than the inorganic growth, there are a lot of opportunities in the visa outsourcing market. In the last 2 years, we have won a lot of new contracts with Estonia, Germany, Portugal, and now these big governments in the European, in the UK, in Canada, they're all coming out with the tenders wherein we have been working with them for a couple of years. So we are quite hopeful in winning certain market share. So as we go along, the revenue from those contracts gets added, geographies of Russia and China gets added, gets opened up. So definitely there will be an increase in revenue and profitability of the company.
Okay, and any value-added services that you can look at apart from what you're doing currently? Because your revenue per application, as we discussed earlier, is up about 20 to 30%. What are the other avenues that you perhaps have to, in terms of like value-added services?
Correct. So we are looking at constantly upgrading our stream of offering services. In e-governance business, there is different kind of services that we offer. In our visa business, there is different kind of services that we offer. Now, post-COVID, the consumer demand has greatly changed. People are now opting for more mobile biometric services. They do not want to visit the center. They are opting for courier delivery services, prime time services. On the e-governance front, we are doing interesting tie-ups with different companies. We are assisting in e-commerce. We are selling insurance products. We are selling different kind of products, from our centers, wherein we have high footfall in tier 2 and tier 3 cities.
Just a word on the margins. Margins now stand at 15.9%. You have been consistently improving them because of the kind of value-added services that you provided and the cost optimization. Can you talk a bit about this cost optimization? Where is it that you brought down cost? And do you think you can further lower your operational costs?
See, definitely during COVID, all the companies, including us, had a realignment of costs because, that was a time when we had to really think out of the box. So we also got to know that certain costs that we can operate certain businesses at a lower cost. So those costs, we are trying not for them to come back, but because of also economies of scale that have come in because of the new contracts that we are winning, in the visa space and e-governance space, we are utilizing the same existing offices for more applications and more revenue. So I think both these factors are responsible for, increase in margin for us.
Any target margin? 15.9% is where it stands at. What could be the sustainable long-term margins?
See, definitely right now we would want to maintain the margins that we have achieved, in the last quarter. And going forward, our objective is always to improve our margins with two factors, which is increase in revenue per application and control over our costs. So definitely there could be an increase in margin, but at this moment, I would say that we want to maintain the margins that we have.
Okay, you want to maintain the margins that you have. All the best. Thanks a lot for joining in. That's BLS International Services. Let's slip into a quick break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay with us. Welcome back. As promised, let's shift focus now to the commodity space. Manisha Gupta is joining in, and today the focus is on crude oil. Manisha, it's been a sharp slide, but there's so much volatility as well in the world of crude.
Oh, it is, yes, Sonia. And if you look at the month of November, we've seen 10% of a decline come in for the crude oil prices already. From a high of almost $98 a barrel to around 86, 87 is the kind of low that we've seen, holding around those levels right now. But after yesterday's slide to 5% at one point in time, not only have we seen the crude prices recover, but Asian markets are trading in the positive right now. The whole hell broke loose after that Wall Street Journal report, which said that OPEC and allies in its 4th December meeting could be looking to increase production. After that, of course, OPEC, Saudi Arabia and Russia have reiterated and talked about not increasing, but perhaps cutting production because the prices have declined so much. And everybody has been talking about lower demand going forward in this year and the first quarter of 2023. That is when you saw buying coming into the markets. So what the street would really watch out now for is the December 4th meeting itself, where OPEC and allies will review the production policy and talk about global demand going forward as well. So it would be interesting to see on what they decide for the month of January there. In the meanwhile, you already have seen Chinese COVID cases continue to increase. China already has cut its December import volumes by half from Saudi Arabia, and that would continue to weigh onto the prices here. The other important thing that the street will watch out for is the December 5th price cap decision that is expected to come from G7 and the European Union. If that comes in, that perhaps would be supportive for prices, because Russia says if that happens, then it would stop providing crude oil to all those countries who are participating in this price cap. So the next 10-15 days are going to be very volatile, interesting, eventful when it comes to crude oil prices, and that's exactly what we've already seen in sense of price moves.
Indeed, yesterday wild swings, right? Down $5 from $87 per barrel to 82 and then back again to 87. If that's a precursor of the volatility to come, then we're in for some interesting times. Thanks, Manisha, for that. Let's slip into a break. We'll come back and discuss market technicals. Mitesh Thakkar of earningswave.com joins in next. Welcome back. Ease My Trip has moved to the high point of the day. It's up 15%. Even yesterday, the stock was locked in an upper circuit of 20%. It went ex-bonus yesterday. We had a chat with the management and the company indicated that their market share is close to about 11 to 12%. The second half of the year is going to be a lot stronger. And they're also looking for acquisitions, whether it's in the bus aggregator space or even in the hotel aggregation space. So watch out for acquisitions, perhaps, from Ease My Trip. Muscat Dock and Cochin Shipyards. Now, these stocks had a relentless one-way up move since the beginning of this month. Just in the last two trading sessions, both these stocks came in for some steep profit booking. But today, they're back again and seeing a lot of buying interest. Pull up a one-week chart or a two-week chart, and you would see how the stocks were up and away. And in the last two trading sessions, there was profit booking. But today, there is buying, which is resumed. And of course, PSU banks, that's clearly the big theme, especially outside of the markets. IOB is now, has slipped from the day's high. But across the board, you are seeing some big moves. Keep your eye out on Mindtree as well as LTI. Now, tomorrow is the X date for the merger between Mindtree as well as L&T Infotech, which means if you want to buy Mindtree shares in order that it can get amalgamated with LTI, today is the last day. Today will determine your eligibility. So these two stocks should be on your radar. A quick word in terms of the merger ratio, 100 shares of Mindtree will be equivalent to 73 shares of LTI. Also, the MSCI rejig will take place. Now, both these stocks are present in the MSCI, but today MSCI will delete Mindtree, and consequently that weightage will go to L&T Infotech. So, just a quick update as these stocks, the X date is tomorrow, so today is the last day to determine the eligibility.
Okay, well, take a look at the market. It is picking up a little bit of pace right now. So the Nifty is back at 18,200. Largely, you'd have to say it's a day where not too much activity is taking place, slightly on the slower side, but there are plenty of stocks that are moving around. This is the first time that you're seeing some real profit taking in banks, especially PSU banks. So Mitesh Thakkar of earningswaves.com is with us. Mitesh, what's happening here? Do you think the rally in PSU banks is now done? And what is the way forward, especially for names like Bank of Maharashtra?
My sense is that I think, they've had a very good stretch on the upside. And now I think some kind of profit booking will happen. In fact, while the medium and the long-term charts still look very, very positive, but if you look at the short-term charts, extremely overbought, and very, very likely that there'll be profit load shedding and profit booking happening over here. In fact, the Nifty PSU Bank Index, I think that's hitting the levels of all-time highs, which was recorded way back in around 3.5 years back. And I think that's why you will see that with overbought levels, the index is hitting important supply pivots. Some profit booking is very likely. So I think about 7-8% kind of a dip could easily happen, given the fact that these stocks are run by about 25-30 points.
Okay, 7 to 8% decline from these levels. Mitesh, any thoughts on the Nifty? We're not going anywhere at 18,200 right now. Any trade and the other stocks that you're recommending?
See, on the index, we've maintained a slightly cautious kind of an approach for the last 2-3 days. Purely, again, the fact that we kind of again hit that level of 18,350, 400 zones. And then from there, the hourly charts have turned slightly negative. So I think this will call for a consolidation. I would still hope that, that the levels of 17,980, 18,000 will come into play, and that kind of a dip will give you a very good entry opportunity with a 60-70 point kind of a stop on the downside. So we're not trading the index unless until we see a breakout beyond 18,400, or I think, patiently waiting it out for it to dip to about 18,000 levels to enter afresh. That's on the index side. On the stock side, I have one buy and one sell. I have a sell on SBI Life with a stop at about 1241. Look for targets of around 1200 over here. while on the buy side is Sun TV reversing from extremely oversold levels after hitting the 200 average. This is a buy with a very tight stop at about 480 for targets of 501.
Okay, Mitesh, thanks a lot for that. So that's on Sun TV, and a quick technical check on the market. Let's take a short break. Up next, we have a market guest joining in. Satish Ramanathan of GM Financial Asset Management will be our guest to tell us about the stocks to watch. Stay tuned. Welcome back to Trading Hour on CNBC-TV18. Rather slow day today, but plenty of stocks to talk about. Satish Ramanathan, the Chief Investment Officer Equity at GM Financial Asset Management, joins us now to discuss his view on the market. Satish, good morning, and thank you for being with us on the channel. I wanted to start by asking you about what's happening with these platform companies. It is, a big downfall that we're seeing across the board in stocks. Investors are exiting in a big way. What do you do with names like this, whether it's something like a Paytm, Nykaa, Delivery, PB Fintech? Do you stay away entirely, or do you look for some opportunities here? Because some of them are seeing improving fundamentals.
Our philosophy is to buy into companies where cash flows are visible. As of now, in many of the platform companies, we do not see the cash flow coming through. And we would look at them at an appropriate time when the cash flows are visible, and then consider them accordingly. But as of now, the valuations are a little stretched, and we would wait for a better opportunity. That said, platform companies are going to remain as part of our economy, and we are quite convinced that they do represent a good opportunity over time.
But even after a near 50% fall from the lifetime high levels, you don't see the valuations attractive for these platform companies. Got that point. You recently launched a JM mid-cap fund, which closed for subscription on 14th of November. Is this the best time to get into mid-caps now? A lot of, people are saying that perhaps the next leg may be driven by the large caps. Your thoughts on mid-caps, the valuations right now, and in the mid-caps, where is it that you are seeing value?
So thanks for this. In the mid-cap space, what we have seen over time is that mid-cap companies have restructured their balance sheets, and they are about as strong fundamentally as the large-cap companies. And they also offer higher growth, and some of the sectors are not represented in large caps. And consequently, we believe mid-caps are the only way to go in capturing some of these high-growth sectors, such as healthcare, such as retail, and QSR. So these are some of the sectors that are well represented in mid-caps. The entire manufacturing gamut of companies are in the mid-cap space. We do not have too many of them in the large-cap space. So structurally, we are fairly positive on mid-caps. And valuations-wise, they are about as good or as bad as large caps as things go. So we are pretty okay with that.
Okay, and within mid caps, any individual sectors or pockets that look good to you from a longer run? Mid cap IT is coming back marginally. You have, the specialty chemical space has so many companies that have recovered from their lows. There are some new listings there as well. What are the sectors that you like?
So sectors that we like are manufacturing.
Okay.
We definitely like the manufacturing sector because with Atmanirbhar and India coming as a China plus one alternative, and our demographics also playing out in terms of the labor pool increasing. I think India stands very well in the manufacturing space. And we think that India will become an alternate export hub as well. The second space that we are fairly positive on is, as you mentioned, mid-cap IT. Some of the structural IT companies like data analytics, etc., will be found in the mid-cap space. So we haven't identified anything as such, but we think that that's an interesting place to shop for. And the other place that we are also positive is the consumption space, be it retail or QSR. We think that's going to be a longer-term structural story. Valuations at the appropriate time, we would be considering many of these stocks as well.
Two of the pockets where we've seen high interest right now, one is defense and the other one are these rail PSUs, railway stocks. Are these pocket segments that interest you? If yes, why? And if not, why?
So we do think that defense and railway PSUs have embarked on a new structural story, and it's all driven by government capex. But we are also cautious because what we have seen in the past cannot be easily forgotten, because receivables is something which are sticky. Government doesn't pay on time very often, and the order book is lumpy and volatile. So that said, I think we are on a good trajectory as it stands today.
And buy them right now given the recency bias?
Yeah, the recency bias is one factor that pushes these stocks, yes.
Okay.
No, I think the question was, would you buy them now given the recency bias, or would you stay away?
No, I think the trajectory, the government momentum, and the cash flow that we are seeing, and the conviction that the government has in localizing defense, localizing railway supplies, and modernizing railways are factors that make us positive. But I just wanted to give a caveat that, that things can turn very quickly because the government doesn't pay on time very often. We have seen that in the case of infrastructure companies. We have seen that in the case of even capital goods companies. So we just need to keep that at the back of our minds and probably go with the momentum as it stands today.
Okay, that's on defense. I just had one more question on what's happening with the telecom space. The reason I ask is because as we speak, Bharti Airtel is at a fresh 52-week high. It's had quite a good run this year. I mean, it's up 30% this year already. Do you see further potential here for Bharti, Reliance in the telecom space, given the kind of positive triggers that they have?
I think telecom has consolidated significantly, and we can see it happening in our personal experience as well. That there are very few options in the telecom space for operators, and it's either Airtel, Vodafone, and or Jio. So when this kind of a structural consolidation takes place, it's a matter of time before tariffs start nudging up and we get better profitability. Also, in terms of capital efficiency, we see the telecom space becoming more efficient once they move to 5G. So we remain structurally constructive on the telecom space. But that said, it's still a utility. It still has government caveats coming in terms of pricing, in terms of the spectrum, things of that sort. So we have to play it accordingly.
Satish, pleasure speaking with you. Thank you very much for joining in. That's GM Financial View, the CIO of GM Financials. Let's talk about Kaynes Technology. That's made a strong debut on the bourses today. The company is listed at a premium of 32%. Vaishta is here with all the details and the important management takeaways.
Hi Reema, thanks for that. Kaynes Technology, as you mentioned, has made a very strong debut today. Listed at a premium of 32% and is coming at 778 rupees per share. It is an electronic system design and manufacturing services company. The customers are across various industry verticals, which includes the likes of automotive, industrial, aerospace and defense, medical, railways, consumer, IoT, IT, etc. The issue size of the IPO is 858 crores. With the fresh issue of 530 crores and the rest comes from the offer for sale. The promoter holding current pre-issue was at 80% approximately and post-issue comes in at 63%. The proceeds of the fresh issue are expected to be utilized for investment in a subsidiary for repayment of debt, working capital requirements, also for capex at their existing manufacturing facilities. We hosted the management on our channel today morning and they said that the FY23 revenue guidance is coming at 1200 crores. FY22 revenues were at 706 crores, so that is a major jump. FY25 EBITDA margins are targeted at 14.5%. FY22 margins were at 13.3%, so there's a jump there as well. Also, medical electronics is a focus area for the company as it is a margin accretive business. Aerospace, defense, outer space and nuclear segment will contribute 8 to 10% of the revenues for the company by FY25, which currently is at 3%. Also, China-Taiwan war could be a major threat for for the growth prospects of the company, as 10% of the total raw materials are sourced from China and most of the processes are made in Taiwan. Back to you.
Okay, thanks a lot for that. Well, Paytm is really the stock of the moment. There's a huge supply overhang that's pushed Paytm lower. The stock has hit an all-time low and is now down almost 80% from its issue price. Vivek is here to tell us more about that. Vivek.
Well, Paytm definitely the stock in focus. So a lot of these new age companies actually have seen the expiry of the lock-in period, which basically indicates that selling as far as anchor investors or pre-IPO investors is concerned is something that can start, and which is what we are seeing across most of these companies. Paytm has not been an exception. The worry of the stock supply is clearly weighing as far as the stock performance is concerned. Remember, the lock-in for Paytm ended on November 15, 2022. Now, in terms of block deals, SoftBank actually sold close to 2.93 crore shares, at 555 rupees a share, and post this particular block deal, SoftBank continues to hold almost 12.95% stake in the company. However, the caveat is that SoftBank cannot sell these shares for the further 60 days. However, what's actually weighing down as far as this particular shareholding pattern is concerned is that there are other companies or there are other shareholders in the stock who actually right now, post the expiry of the lock-in, can sell. And some large shareholders, are the Alibaba group. If you're talking about this particular group, over 31% stake is what they hold as far as Paytm is concerned. Now, just have a look at, the price performance of Paytm since the listing. Stock listed on November 18, 2021. The IPO allotment price was close to 2,150 rupees a share. And today's low indicates that the stock has eroded over 75% of its own stock price as well as the market cap.
Thank you very much for that. This has been the big theme as the lock-ins of these new companies, recent IPOs have opened up. We have seen intense selling pressure coming through. The latest one, of course, is Paytm. No block deal today, but the stock is down close to by 8%. Get into a break. On the other side, we'll wind down the earnings season for the second quarter. Prateek Parekh of Nuvama Group will be... Welcome back. As we wind down the second quarter earnings, Nuvama Group has come out with its earnings review. The report says that though the top line was strong for the companies, the cash flows have remained weak. Prateek Parekh, the equity strategist at Nuvama Group, is here with us on the show now. Prateek, that is the first question, right? Your analysis of BSE 500's private sector's operating cash flow growth has slipped into contraction in the first half of this year, H1 FY23, a historic low. Just provide some more data around this and what the implications are.
Yeah. First of all, thanks, Reema, for having me over. Clearly, I think if you look at the cash flows, right? I mean, there's an old adage which says that top line is vanity, bottom line is sanity, and cash flows are reality. So in some sense, that holds very true in the current context. For example, in H1 so far, we have had very strong top line growth of 25% plus. The earnings growth has been a bit more moderate in single digits, but I think cash flows is where which has been seen maximum weakening. Now, if I look at the weakening of cash flows, it's happening owing to deterioration in working capital, where we have seen an increase in receivables and also inventories of sorts per se. What this essentially means is two things. One is going ahead, you could see some moderation in demand because you've had very good receivables and inventory build-up. And second, and more importantly, if cash flows are going to remain weak, I think it will weigh on private sector sentiments, and their willingness to do capex will be undermined, especially in a scenario where interest rates are rising per se, Reema. So to that extent, I think going ahead, it does not augur very well from a demand or a capex standpoint per se, the current situation.
In your note, you also say that you're overweight on cash-rich defensives, which benefit from commodity disinflation. Can you just elaborate on that? What kind of stocks are you looking at?
Yeah. So if you look at the current environment, right, we are entering an environment in which, Fed has been tightening, and as a result, liquidity is still pretty tight globally. But the impact of Fed tightening that we have had in 2022 is now showing up. We have had global growth decelerating very sharply, and commodities, which were inflating very sharply for over the last 2 years, are now decisively in disinflation. In this scenario, I think overall growth, the nominal variables will slow down very meaningfully. But the sectors I think that will benefit are those where demand resilience is reasonably high, and also which will benefit from input prices falling. The sectors that typically fall in this category are, something like FMCG, where I think, which had a very big pain point on the margins front, I think should benefit from going ahead from here on. Similarly, something like cement, where demand for cement in India is relatively less cyclical given its high rural exposure. They too will benefit from commodities inflation, and something like two-wheelers as well is what we like, where we think that the demand has been very weak, recovery has been very weak post-COVID. So low base accompanied with falling steel prices should boost earnings of these sectors per se, Sonia.
Hmm.
So we are essentially overweight consumer companies which have very high demand resilience and also which have had significant margin pressures in last 2 years owing to high commodity prices. There, I think the tide will be exact opposite over the next 12 months per se.
Pratik, I remember chatting with you on this show about a month and a half back, and that was when you had downgraded banks, your assessment. But since then, the banks have actually moved from strength to strength. We've only seen banks outperform, and the consensus view seems to be that the balance sheet of the banks is the best that we've seen in a decade. The return ratios are strong, lending has picked up across the board, and this is kind of a rising tide which is going to lift the entire banking sector. Would you stick with your view? What has been, the data points that you've picked up in the last month and a half since the time you wrote that report? Because we've had the earnings picture as well from the banks.
Yeah. Again, great question, Rima, for that. So clearly, now with the benefit of hindsight, it suggests that we were early in our downgrade of financials. But I think if you look at this quarter, right? I mean, this has been a picture perfect quarter for banks. We have had decadal high ROAs, and all parameters have fired. You've had margins accelerate to a decadal high. Credit growth again has been very strong, and asset quality very benign. My worry is that going ahead, this picture perfect may not remain so for very long. Since our downgrade, the data points that have come out on the growth front on the economy, whether we look at some high frequency data like exports, or whether we look at the non-oil, non-gold imports, which reflects your domestic demand, consumption, so on and so forth, have slowed materially. The second factor that has come out, since our downgrade is on the prices or WPI front. Now, mind you, a high WPI is very good for banks because it increases your working capital requirements and as a result, your loan growth. WPI growth for manufacturing, which was at 8-10% a year back, has slowed very sharply to around 3-4% now. And given the dynamics and given what's happening to global WPIs, it is likely that this will go down further lower from here on. So to that extent, since our downgrade, while banks have rallied, if I look at the high frequency data, our conviction on the same, has only increased. And to that extent, we maintain that while currently banks are enjoying a very good ride on both margins, growth, as well as asset quality, going ahead, while bank balance sheet will remain strong and asset quality will not be a concern, but I think the consensus exuberance on margins remaining high for longer and credit growth sustaining for a very long time, I think that is at risk. You could see both margins as well as credit growth moderating over the next 3-4 quarters per se, Rima.
Okay, thanks a lot for joining in. It was a pleasure speaking with you, but we need to take a short commercial break. A quick programming note, to fully commit to the cause of bridging the gender parity gap at the workforce, CNBC-TV18 is all set to lead charge with a one-of-a-kind mega initiative, Future Female Forward, the Women's Collective presented by HSBC India. The initiative will be officially launched through an exclusive on-ground event on Friday, November 25th at the St. Regis, Mumbai, in the presence of Shireen Bhan, Managing Editor, CNBC-TV18, Hitendra Dave of HSBC India, and other women leaders of India Inc. Also in attendance will be some of the most influential voices from the business, entrepreneurship and entertainment spaces. Don't forget to tune into CNBC-TV18 on Friday, November 25th, 5:30 p.m. onwards. Welcome back to Trading Hour. The stock of the moment undoubtedly is Easy Trip Planners. That stock is up almost about 14% right now. We did, talk about it earlier, but the company and the commentary from the company was quite good. They're talking about how, the second half of the year should be better than Q2, and their market share at 11-12%. They're planning to grow it further. So the positive commentary perhaps is something that the market liked. They also spoke about how competitive intensity is decreasing. So that clearly is the stock of the day. When the management spoke to CNBC-TV18, the street liked that. UCO Bank is the other one, 11% higher. So I'm just spotting a lot of the double-digit gainers this morning. Central Bank of India is also moving higher, but it's had a very smooth run this month. Central Bank of India is up almost about 30%, and so is the case with something like an Amara Raja Batteries ever since it came out with its numbers and positive trajectory there. The stock is up 30% this month. But we will wind down with Trading Hour. We leave you with some important market opinion coming in from Rahul Chadda of Mirae Asset Global Investments. Thank you so much for watching. Halftime report comes up next.
We've been cautious on markets for the last 6 to 9 months, and we continue to have that view. Look, markets are going to be range bound at least for another 6 months. We've seen YTD. I was looking at the performances here. Look, Indian market has done its bit by falling the least amongst the regional players. In dollar terms, the market's down about 7% compared to, let's say, S&P, which is down 17%, HSCI, which is down 25%. So I think for next 6-9 months, we would be range bound. It's only when markets get discomfort that the Fed's moved away from peak hawkishness to neutral and is becoming more dovish. And the same thing happens with policy making in India also, that the central bank moves from raising rates to neutral to probably cutting rates. If you look at the numbers, those numbers have been phenomenal. These names have not done anything for 10 years. So there was obviously a pent-up demand for this. These names were under-owned. Thankfully, we had some of these names about 2 years back, enjoyed the rally. Last couple of months, we were a bit kind of a circumspect here, and the reason was a bit worried on the macro front. We'd seen sharp drawdown in forex reserves. Thankfully, that pattern's been corrected in recent weeks. We've seen some bit of an increase in reserves. Again, bulk of our financials exposure would be still private banks. One would have some PSU banks, but these would be the leading PSU banks like SBI, some little exposure to BOB, etc. One has to see a pickup in the private sector capex. There is a little bit of an increase here and there, but not a broad base pickup in the private sector capex. But should that happen, I think infrastructure cycle can be a multi-year cycle. And this is a trend we believe is going to happen in the coming decade, that as reshoring happens, as manufacturing moves away from China, as countries want to take control of their strategic manufacturing, etc., I think the domestic cap goods companies are going to benefit from that.